Welcome to the daily briefing for July 5, 2026. On this channel, an AI screens the market every single day for undervalued quality stocks, and every pick gets accumulated through dollar cost averaging, with fresh names added as they appear. U.S. markets remain choppy as investors weigh sticky rate expectations against resilient corporate earnings, keeping quality growth names on sale. That kind of volatility is exactly where this screener hunts. Today the screener surfaced 5 picks, so let's get into them. Adobe is the software giant behind Photoshop and the Creative Cloud suite that powers the world's designers and marketers. The stock sits roughly 42% below its high, in the 98th percentile of historical cheapness, and a reverse DCF says the market is pricing in slightly negative growth of about -2.6%, remarkable for a business compounding revenue at 10.5% a year. Quality is elite, with an 89% gross margin, a 70% return on invested capital, and a fat 10.6% free cash flow yield. Earnings per share grew 57%, giving the fundamentals clear upward direction. The key risk is that generative AI tools could erode Adobe's creative software moat faster than it can monetize its own AI features. Autodesk makes the design and engineering software, like AutoCAD, that architects and builders use to model nearly everything constructed around us. It trades about 36.5% off its high and, like Adobe, sits in the 98th percentile of valuation cheapness, with the market implying only about 3% growth while revenue actually compounds at nearly 13%. Margins are stellar at 92% gross, return on invested capital is 51%, and earnings per share more than doubled with 108% growth. Free cash flow yield of 7% means you're paid well to wait. The main risk is Autodesk's exposure to construction and manufacturing cycles, which can slow new subscriptions in a downturn. AppLovin runs an AI-driven advertising engine that matches mobile apps and e-commerce brands with the users most likely to spend. This is the momentum pick of the day. Revenue is compounding at 25%, earnings per share jumped 89%, and return on invested capital is an extraordinary 130%. The stock is 28% off its high, though its valuation percentile of 25 means it is not cheap against its own history, and the market is already pricing in about 22% growth. In other words, you're buying elite execution rather than a bargain. The key risk is exactly that: any slowdown in ad tech growth, or a privacy rule change, could hit a stock priced for perfection. Abbott Laboratories is a diversified healthcare company selling medical devices, diagnostics, and nutrition products, best known for its Freestyle Libre glucose monitors. The stock is about 29% below its high and sits in the 90th percentile of historical cheapness, a rare discount for a defensive blue chip. Earnings per share surged 70% as post-COVID comparisons cleared, though headline revenue growth is nearly flat at 0.5%, and return on invested capital is a solid 15.6%. The reverse DCF implies about 11% growth, so the bet is that the device's business keeps outrunning the fading diagnostics drag. The key risk is that flat top-line growth persists, leaving the earnings recovery to do all the heavy lifting. Alexandria Real Estate Equities is a REIT that owns laboratory campuses leased to pharmaceutical and biotech companies in hubs like Boston and San Francisco. It is the deep value pick today, down 36% from its high, in the 88th percentile of cheapness, with the market pricing in roughly 8% annual decline, a very low bar to clear. The cash story is compelling with a 15.4% free cash flow yield, and earnings per share grew 86% off a depressed base. Note the accounting quirk: reported return on invested capital is slightly negative, which is common for REITs where depreciation masks real property economics. The key risk is a real oversupply of lab space and biotech funding weakness keeping vacancies elevated longer than expected. That wraps up today's 5 picks: 2 deeply discounted software compounders, a priced-for-growth ad tech machine, a defensive healthcare name, and a contrarian lab space REIT. Each one enters the portfolio through steady dollar cost averaging, and we'll track how they perform against the S&P 500 in the days ahead. Same time tomorrow for the next screen. This video is auto-generated for personal record keeping and is not financial advice. All investment decisions are your own responsibility.